Hi, it's Jared Friedman from Redwood Financial Planning. I made a video to discuss the investing mistakes we all need to learn about. Please stick around. I take my emergency fund very seriously. Having cash on hand is the only true safety net that will help me get out of any financial jam, including investing mistakes. Access to credit is a lifeline too, but it doesn't squash the problem, it only kicks it down the road. So before I even consider investing any money, I make sure my family is protected for up to 6 months in case my business slows down, we get into an accident, or even if the roof springs a leak. The savings account today is not sexy. It's actually quite boring, and online banks are currently paying between 25 and 50 basis points. But the peace of mind it provides me is priceless. Above and beyond my emergency fund, I choose to invest my money in the stock market and real estate. Historically, they've provided attractive returns, and I also understand the volatility that comes with it. The money that I put to work is not money that I need to pay the mortgage or even my kids' daycare bills. My investment accounts can withstand the short-term downturn in the market only if I don't need access to that cash to pay any regular bills, so I keep them separate. This is the second layer of peace of mind an emergency fund provides. With all that being said, we can now talk investing. Investing is taking money you have today and putting it to work with the hope that it will increase in value over time. Instead of purchasing some material object or going out to eat today, by investing, I'm choosing to delay gratification with the chance of receiving more money in return in the future. At best, it is a risky proposition, and sometimes even the best investment ideas don't work out. Now, I can't predict the future, but I do know that if I can avoid these 8 mistakes, I'll be able to improve my investing results, and so will you. So read them, understand them, memorize them, and avoid them. Number 1, the inability to take a loss and move on. If you're holding on to an investment that is a loser, sell it and walk away. It might never make it back to your purchase price. Never. Number 2, not letting your winners run. You don't have to sell your investments as soon as they turn a small profit, just to lock in some gains. It is actually in your best interest to let your winners continue to climb. It's okay to set some sell parameters so all your profits don't get wiped out, but let them go on as long as you can. Number 3, investing without a plan. Standard conversation between me and a client. Mr. and Mrs. Client, why are you investing this money? They usually say, because we want more money. Then I say, but how much do you want? And they say, well, as much as possible. This is the worst reason to invest. Because how do you know when enough is enough? How do you know when to stop taking risk? Investing is a means to an end, a roadmap to achieve your goals, such as providing college education for your kids or funding your retirement. Without a financial plan, how will you know how much you need to accumulate to achieve these goals? How much risk should you take? And what types of returns do you need to shoot for? Are you on track towards your goals? Essentially, investing without a plan is like hopping in the car without any idea where you are headed. Number 4, trying to time the market. Our brains are not built to buy low and sell high. It's actually wired to do the exact opposite, because when things are flying high, you want to jump on board and enjoy the fun. And when things are at their worst, it's natural to want to run away and hide. Stop thinking you will be able to overcome millions of years of evolution. You can't, and I can't. Because of that, trying to buy and sell based on daily fluctuations is not possible. You are almost guaranteed to get in too late and get out too early. And if you do this enough times, poof, all your money will be gone. Number 5, not paying attention to your investments. Many times I show up to potential clients' homes before COVID and see unopened envelopes on their kitchen table. Now, once I sit down and take out my pad, they immediately push all of the envelopes toward me. If I was new to my profession, I would be totally confused. I mean, I don't want their mail. Why would they be giving it to me? But because I've been around the block for a while, and I know this isn't my first rodeo, I know exactly what's going on. These envelopes are filled with their investment account statements. I'm talking E-Trade, maybe the 401k, an IRA, you name it. And normally these envelopes would go in the trash. But because I was coming over, they knew they had the decency to save them. Now your portfolio needs to be evaluated and monitored on a periodic basis. The companies you have invested in can go through major changes or tough times, and the funds you have could have diverted from their stated objectives, or more importantly, maybe your goals have changed. I'm not telling you to track every day, but at least quarterly open the envelopes and take a look. Number 6, failure to rebalance your holdings. Diversifying your portfolio correctly means that at times when some things are going up in value, others might be going down. That is okay and expected. We do not want all things to move together. However, if one or two investments move dramatically up or down, this could cause your portfolio to be out of balance. It can even make your portfolio move risk levels. The idea behind rebalancing is to actually control risk. If stocks rally and your allocation has grown from 75%, from 65%, or maybe now your portfolio is taking less risk than you originally planned, you can also experience more losses. Have a plan to bring these things back in line. Number 7, assuming recent events will continue forever into the future. Whatever economic climate we are in, it will not last forever. Good or bad, the economy moves in cycles, and you should be invested to withstand all moves. In great markets, don't pile into risky stocks, and in bad markets, don't gobble up all the bonds or gold you can buy. You shouldn't build a portfolio for the news of the day or cycle of the week. Number 8, building a collection of investments instead of a well-crafted portfolio. Each investment in your portfolio should have a purpose and not just be the hot ticker of the day. Whether you're trying to increase income or reduce volatility, each investment can help or hurt your overall goals. Avoiding these 8 mistakes will be hard, very hard, and maybe you have already committed a few of them already. But all of this is okay. We need to stop looking to the past and focus only on the future. By avoiding these mistakes going forward, you will increase your odds of being a successful investor. Thank you for watching. Please subscribe to our channel so you don't miss out on any future videos. And as always, have a great day, and I hope you achieve financial success. Thank you.